In Chapter 9, we take a look at savings, investment, and the financial system. Let me just say two things off the top. But first of all, you may see an appearance by my canine teaching assistant in this video as he's busy off to my right chewing up a toy at the moment. But so don't be surprised if he makes an appearance. Second, and more seriously, one of the things this chapter covers at the very end is the financial crisis of 2007 and 8 and the Great Recession. I'm not going to talk at all about that in this video. If you look at the materials for the chapter, there is a separate short lecture I gave on that topic, actually while the financial crisis was happening about 10 years ago, that you can watch, and a reading as well that addresses some of those issues. So those two things I think are really helpful for thinking about the financial crisis and Great Recession, and helpful in ways that I think go beyond what the discussion in the textbook, which while I like parts of it, there's other parts of it I think there's some things missing there that I tried to fill in with those two supplementary sources. So with that in mind, let's talk about saving, investment, and the financial system. The key thing to understand off the top is that saving, investment, interest rates, the financial system work the same way as any other market. And the easiest way I think for us to think about this is to think about it as the market for loanable funds. This is not language that the textbook uses really, but for me, it's the way to sort of really think most clearly and sort of see this in terms of supply and demand most clearly when we think about it as the market for loanable funds. So we have two things happening in the market for loanable funds. We have the supply of savings, that is the supply of loanable funds, and the demand to borrow, the demand for loanable funds. So some people are supplying funds to lend, other people want to borrow funds. They are demanding those loanable funds. So I think thinking about it that way perhaps is the most helpful. So what's the importance of this sort of market, right? Is that we want to get resources from savers to investors. Remember from last chapter, investment was crucial for capital accumulation and economic growth. Okay, how do we get people to invest in capital? How do we get people to buy the machines and invest in the machinery to sort of make new stuff and generate growth? Well, to do that, they need to get savings from somewhere, right? One of the things about production is it takes time. And there's a time lag between when you start a firm or a project and when it eventually produces the output. So we have to sort of cover that time. Like how do we pay for the machinery, and how do we pay workers, frankly, until we start seeing the revenues flow from those projects. Savings is what enables us to do that. So the challenge here for investors, for borrowers, is how do I get access to savings most easily so I can do these projects I want to do. But on the other side, right? Suppose you earn a nice income and you have money you want to save. You'd like to take that money and get some interest for it. What do you do? How do you do that, right? Where do you go? Do you go knock on people's doors and say, "Hi, my name's Steve. I've got some extra money lying around. You have a project that you'd like, some help with?" You can see the problems here. First of all, this is extremely costly, going around knocking on doors. And how am I going to judge the quality of their projects, and what are they going to say to me? So one of the key things about savings, investment, and the financial system is we have what we call financial intermediaries, like banks. It's the easiest one to think about, whose job it is to play the middleman here, right? To collect the savings, to collect the supply of loanable funds from lots of small borrowers, pool them together, and make judgments, right, about who to lend that to. And so the demand for loanable funds, the investors come to banks and say, "I'm not going to go knock on people's doors," right? Can you imagine Steve Jobs having shown up at your door and saying, "Hi, my name's Steve Jobs. I have this idea for this computer company. Got any money you want to lend me?" I mean, again, we're not going to do that. But it's a lot easier, right, when there's one centralized location like a bank where you can go to do that. So one of the key things about banks and other financial intermediaries is they cut down on those transaction costs. They cut down on those costs of finding trading partners. They do a lot of other things too. Banks have expertise that enable them to assess the quality of borrowers, and that reduces that helps to reduce risk. The fact that banks hold a portfolio of different borrowers, different investments, that helps to reduce risk. So there's lots of benefits to using financial intermediaries. It's also important to understand that those intermediaries make their money, of course, by the spread between the two interest rates. The interest rate that they pay savers and the interest rate that they charge to borrowers. The difference between those two is how banks make a profit, pure and simple. So banks, financial intermediaries, connect savers and borrowers that, like all our other connections we've talked about with markets, right, generates gains from trade and smooths economic growth. So let's talk more specifically about savings and investment and all this for a moment. Okay, saving again is income that's not spent on consumption goods. We think of it as the funds we put in the bank, but anything we don't spend on consumption goods is potentially savings. Investment, that demand for loanable funds, is the purchase of new capital goods. And as I've said, again, savings, the supply of loanable funds, investment, the demand for loanable funds. There's lots of reasons why people supply savings. I'm just going to rattle them off real quick. One is the smoothing of consumption. We tend to borrow when we're young, and we tend to save when we're older. When our income goes up, we have more to save. When we're young, we don't have a lot of income, but we tend to borrow to finance our consumption. Another reason is impatience, or relative patience or impatience, right? The more patient we are, the more we're willing to save and delay those returns to later. The more impatient we are, the less willing we are to save. Think of it another way. The more patient we are, the lower of an interest rate it takes to get us to save. If we're very impatient, you have to overcome that impatience by paying us a higher interest rate. There are also marketing psychological factors that the book discusses as well. So what happens here is that people decide how much savings they wish to supply. And it's done the same way as all these other supply curves we've talked about. You can think of it this way. We're saying to people, at this interest rate, how much would you save? Everything else locked up in the box, right? There we go. Right? All we're interested here is how much you're willing to save, how much loanable funds you're willing to supply at different interest rates. And notice here, interest rate is just like every other price. It's the return. In case of suppliers and savers, it's the return to supplying loanable funds. What do you get paid for supplying loanable funds? You get paid the interest rate. Higher interest rate, all things equal, you'll save more. So the supply curve of loanable funds, the savings curve, is upward sloping like every other supply curve. On the other hand, why do people borrow, right? Same reason they save, smooth consumption. Early in life, you tend to borrow more. You go into more debt, more credit card debt, your debt for higher education. Those are ways of ensuring that you're able to continue to consume at a level you'd like to consume at while you're investing, in your human capital or whatever it might be. You can think about borrowing when you're a student or when you're relatively young on the job market, right? As you're moving sacrifices forward, right? When you have a job or higher income, you'll have to pay those off. But for now, you're saying, nope, I'm gonna try to maintain my consumption. And that idea of consumption smoothing, of sort of trying to keep your consumption constant by borrowing when you're young, saving when you're older, is really important. The other thing to remember, as I pointed out before, is people with the best business ideas may not be the ones with the savings, right? And so businesses have to borrow to finance those projects. And the ability to borrow, and particularly to go to a financial intermediary, means that you're able to invest in capital and generate that growth. And as we've said, higher investment increases the standard of living and the rate of economic growth. The demand for loanable funds, that is the demand to borrow, like every other demand curve, downward sloping. The lower the interest rate, the greater the quantity of loanable funds will be demanded. If you lower the interest rate, more borrowers will want to borrow, and more of their projects will be worth doing. If you think about the rate of return on a project, right, and you can kind of line up those rates of return and figure out which ones are worth doing, part of the answer to which ones are worth doing will be, well, what's the interest rate, right? If you've got an 8% rate of return, but the interest rate's 10%, not worth doing. If the rate drops below 8, however, it is. So we can see that as interest rates go down, the quantity of borrowing will go up. Okay, and so this market for loanable funds, like every other market, we have savers trading with borrowers, we have suppliers of loanable funds trading with demanders for loanable funds. Trading in that market determines the equilibrium interest rate, just like every other equilibrium market clearing price that we've talked about all semester long. And you can see the same features hold. In equilibrium, the quantity of funds supplied equals the quantity of funds demanded. Interest rate adjusts to equalize savings and borrowing, just like it adjusts with surpluses and shortages in every other market, right? So everything else is the same, no different than any other market we've studied in previous chapters. Just because we're, in this case, sort of trading credit, trading money, doesn't make a difference. It's still all the same. And you can sort of walk your way through some of the problems in the self-checks in the PowerPoint to see whether you're really getting it. And much like those other markets, changes in economic conditions will shift the supply and demand curve in the same kinds of ways we've talked about with other goods and services. I'm not going to walk through all of those, but for example, just off the top of my head, if people become more thrifty, that is, if they become more patient, right, they supply more savings, that shifts the entire savings curve to the right. Interest rates fall. As they fall, more borrowers are able to borrow. We get an increase in the amount of borrowing, and the equilibrium quantity of loanable funds exchanging hands increases. Again, you can take a look at all of those examples and sort of practice them for yourself. Okay, and again, banks, financial intermediaries play the crucial role here in bringing together savers and borrowers. One other thing I want to talk about real quick is the bond market. Bond markets are another way that people save and borrow. And one of the things about the bond market is investors can easily find more information about large, well-known corporations. That way they don't have to necessarily go through banks and can lend directly to those companies. And one of the ways that companies borrow is by issuing bonds. A bond contract lists how much you owe, the rate of interest, and when payment is due. So if you lend a company $1,000, for example, the bond will say you need to pay back that $1,000 at a certain date. It'll tell you what rate of interest the company's going to pay you on the bond and when all of that is due. So a bond is basically you are lending to a company, it's borrowing from you. They're paying you an interest rate to borrow money. Different bonds work different ways. One of the things to understand about bonds, of course, is that they're a good way to raise money. They can be paid back over a long period of time. However, they do have default risk. It's possible that the company will not succeed and won't be able to pay back the loan, and that affects the interest rate. The riskier the company, the higher the interest rate. Really low-risk companies tend to have lower interest rates. And, of course, U.S. government bonds, U.S. government issues bonds as well. Those are considered very low risk and tend to have a very low interest rates as well. Again, all the things equal. One of the things to think about is when government borrows, what's the effect on the private market, right? This is the idea of crowding out. When government borrows more, it decreases both private consumption and investment. When government's borrowing, it's taking resources from the private sector. So the more the government borrows, the more it crowds out. How much exactly it crowds out varies. It depends upon a bunch of different factors, the shapes of those various curves, but you can take a look at slide 38 in the PowerPoint and see that in action. The other thing I want to talk about with bonds is how when the media talks about bonds, right? We talk about bond prices and interest rates, and I think it's important to understand this key idea. There's lots of different kinds of bonds that the U.S. government sells. Many of them are what are called zero coupon bonds, right? Other bonds, you buy them and there's literally a coupon you sort of in the old days you tear off and you would send in, and that would be how you got your interest payment. But with zero coupon bonds, what happens instead is that they only pay off at maturity. So example, if you want to, what you do with a zero coupon bond, let's say it's $1,000 bond, the company will pay you back $1,000, let's say after the 10 years that the bond lasts. But in the meantime, you're paying a price for that bond today that's something less than that $1,000. And the difference between the price you pay today and the $1,000 you earn later is the interest that you earn. So these zero coupon bonds, right, you don't have to actually do anything. You just buy the bond at a certain price and then get paid back a larger sum when the bond matures, however many years it has towards maturity. What this means is that bond prices and interest rates work inversely to each other. When bond prices go up, okay, when people bid up the prices of bonds, that reduces the interest rate. So, for example, suppose it's a 10-year bond, right? It pays you $1,000 in 10 years. Suppose today you buy it for a price of $900, and suppose tomorrow the price goes up to $950. At $900, you're earning $100 interest on that bond, right, over the course of 10 years, right? The difference between the $1,000 and the $900. But at $950, you're only earning $50, right? Your interest rate's lower the higher the bond price is. So when people are bidding up bond prices, they're pushing interest rates down. When people are selling off bonds and bond prices are falling, interest rates are going up. There's some calculations that show this in the PowerPoint and in the textbook. If you look at slide 48 and forward, you can see that. But this is important to know because we see this talked about in the media all the time, right? That the bond market rallied today, right? Which usually means prices went up and interest rates fell. One last point to think about in this discussion is that the stock market. The stock market is not stock is not borrowing and lending. Stock is ownership. Okay. Now, when a company first sells stock, its IPO, its initial public offering, okay, that it's doing to raise capital. And so when you buy stock the first time, you are providing capital to that firm. But when you buy and sell existing stock, it's just changing hands. It's changing ownership. There's no additional capital there. Last thing I want to say in this chapter is that the financial intermediation system can fail for a variety of different reasons, and when it does, that's bad, as it prevents resources from getting to investors who will generate economic growth. There's many reasons it can fail. Insecure property rights, controls on interest rates are a couple. Politicized lending, if government agencies start lending to people who they favor politically. I told you my canine TA would be here. Go outside. Go on outside. So those are a couple possibilities. The other possibility, of course, is bank failures and bank panics. Okay, some of that talk about in the Great Recession videos that you're going to see. But one point I want to make right now is in the United States between 1929 and 1933, almost half of the U.S. banks failed, and many people lost their life savings. And it's important to understand why. This had a devastating effect on the economy. The book doesn't talk about this too much, but one point I want to make is that many of those bank failures, well, the reason for so many bank failures were that banks at the time could not operate across state lines. And in many states, they couldn't even operate more than one branch within the state. So banks were very small, very under-diversified, and much risk and very risky. And so when agriculture failed, when other things happened, banks easily failed in the United States. If you compare that to, say, Canada, where banks could operate nationwide, they were much more diversified. They didn't have these laws against operating branches. They were much more diversified. Canada during the Great Depression had no bank failures, zero. Some branches closed, but no bank failures whatsoever. So one of the things we have to think about when we think about the failure of financial intermediaries is, what's policy doing? Is policy a problem? We constructed laws that made it difficult for banks to make good loans and diversify and lower their risks. So that's an overview of savings, investment, and the financial system. Again, there's more in the chapter. There's more in the PowerPoint that you should take a look at, but I think those are the key issues.